So this is to move this thing. Okay, so just to start with the dress code, I mean, when I actually decided to leave Tri-Fi, I promised to myself that I would never wear a tie. So I know that a lot of people is wearing, ties, I mean, orange ties. So I decided to go for the socks, and I actually having the hat. So anyway, I'm gonna leave it here. But so yeah, I mean, I think it, very important. I'm gonna probably use a lot of the terminology that you actually have seen in this conference. Great people, great content, and actually, amazing venue. But it's going to be a lot of messages that probably have resonated with you already. But there's one very specifically that I wanted to leave with you, and it's the fact that volatility is an opportunity. Okay, so I know that a lot of people have been talking about volatility to be risk, but it's actually, let's kind of go through how we can do something about it and how we can utilize that. So there we go. So just to kind of set the scenes. And we have been talking about all the strategic use cases of basically BTC for treasurers, but I will actually kind of summarize this into 4 things. The first one is a hedge. I mean, we talk about hedge as an inflation hedge, and a monetary policy is a diversification. We know pretty much that the profile of Bitcoin is actually very different to what you have perceived in equities or fixed income. And very important as well is that it has a very asymmetric distribution of returns. And we have seen that, but it's actually something that we can use to our advantage. And lastly, and very important, is a very mature infrastructure. And I think a lot of you guys have been here in this space for quite a long time. I mean, I've been investing in BTC and Bitcoin since probably 2016, seen all the rights, and the infrastructure has been incredibly different to what we have in terms of microstructure of the market, in terms of how we can do custody and different things. But let's talk about this in a second. So how do we actually think BTC having a strategic edge? And I think a lot of you guys have been hearing from people putting this into the treasury of their companies. And it's mainly because we call it, and I love to call it, digital gold with wings. But it's actually for 3 different reasons. Scarcity, I mean, we heard from the previous speaker, 21 million coins. Liquidity, 7 days a week. I'm a quant investor all my life, and I can't believe of something, finally we have an asset that I can actually put risk or reduce risk on Saturdays, Sundays, when we actually have a news, when we can't do anything about it. This is actually incredible. And very important, actually we trade what? We trade between 50 to 100 billion in a day, if you count the derivatives market. Well, think about it. We talk about a lot of the stocks that we love to trade that we see in the sticker, like Michael Saylor mentioned, that goes in CNBC and all the time passing by, is Apple, Microsoft. Well, actually, Bitcoin trade the same sort of volume of those stocks, okay? And, if you can compare to any G12 currency, particularly the small ones, I mean, pretty reasonable as well volume. So there is a lot of interesting characteristics of this asset. And lastly, and not the least, what I think is incredibly important, is a borderless. It's probably the more secure network that exists, completely decentralized, and that's actually a feature that all the assets that I mentioned to you before can't offer. No fixed income, no equities, none of those companies. So this is actually an incredible advantage that we can do. But everyone talks about the biggest problem. Talk about the issue about volatility. Is it volatile? Yeah, it is volatile. And I think, there was a very interesting quote from Chris from Fidelity, who said that volatility is not risk. Risk is capital destruction. And I agree completely with that. That's exactly what we're actually talking here. But what is volatility, and what terms are we talking about volatility? So you see the graph there. The orange line is the daily, basically changes in terms of daily returns for BTC. Yeah, it's significantly more volatile. But as well, I compare that with the S&P 500, daily changes in their returns. But let's focus on something. Let's talk about the fat tails, or the tails of that distribution. So if you think about it, okay, well, you can see that if I give you a little more of those numbers, BTC, Bitcoin, in a bad day, in the 5% worst days, it actually loses around 5.6%, versus the S&P 500 around 1.7%. Now, if you go to the other side of that distribution and you go to the 95 percentile, so the 5 best days, well, you actually see that, BTC perceived, delivery is something around 6.2%. So minus 5.7% versus 6.2%. So in a quantitative jargon, that actually means is that the distribution is skewed to the positive side. And I think I don't have to say to anyone here, everyone believes that the prior is that BTC will actually go higher. Well, it's actually showing in the distribution of returns, okay? It's there. Now, but if you compare that with the S&P 500, well, you lose minus 1.7%. But if you actually look at the 5 best, performance, it's going to be 1.6%. Well, that's no positive skew. But actually, we love equities. We think equities is a reasonable sort of, trade-off in terms of risk and return. Now, BTC is significantly better. Now, so how can we actually take advantage of that? And I remember I saw the presentation from the gentleman from the CEO of MetaPlanet, which I think is kind of a quite interesting, the analogy that he does, that he has in this slide, that he have a reactor, where you actually have BTC, a reactor, and it has a lot of energy coming out. But that energy, I kind of perceive it to be volatility. Now, the question is, how do you harvest that volatility to your advantage, and which is kind of quite important. Now, the problem is that everyone thinks about one thing. Everyone thinks about holding BTC, a passive asset. Now, oops, do we just cannot go back? Let's see if we can. I think I moved the slide too fast. Is it possible? Yeah, there we go. So basically what actually happens is that, everyone focuses about getting the entry points. And the entry points is holding a passive representation. It goes back into, but I will skip that slide. So it's a passive holding, but you actually can't, you tell me who or you actually suddenly hold assets. And it said it's either a house that you don't use, it's either cash, it's either equities, it's either fixed income that you don't do something about it with those assets. All right, so why do maintaining those assets and not thinking about getting those assets to work? If you have a house, you kind of rent that house. If you want to actually have an equity, more likely if you're a treasurer of a company, you will lend that equity, and you potentially can do something about it. So, but the question always is that how do you measure about the custody? And we hear a lot of people talking about custody. How do you assess the risk, which is very important, and how do you actively manage that risk? So, with that in mind, it is a trade that is actually quite important. So we're going to harvest the volatility. However, you think about this graph that I have here, as soon as we can have more people adopting Bitcoin, volatility is going to continue down. And that graph showed you that the realized volatility of Bitcoin is actually going down over time, as just kind of a completely orthogonal with the fact that you are adopting, you're increasing adoption. Now, if you look at the purple line, it shows you the ratio between retail investors and institutional clients. And you can see that the last year, that line is not growing, it's getting flat. What that means? There's more institutional comments into this. And volatility will continue to go down, because a lot of what I'm saying to you, we do it for clients, and they are mainly institutional clients that are actually harvesting volatility. Now, the important thing is that, okay, well, volatility is coming down. That's true. But actually, it's still pretty high. So if you see what actually happened recently in terms of the events that we have with the tariff, we go the VIX going out to 50%. Well, that's the standard sort of level that we see with Bitcoin. All right, Bitcoin usually volatility trades around, depends if they're 60, 65, 70%. And we want to talk about how the surface looks like. But it's still pretty structurally high. Now, why you would actually sell volatility? What is the benefit of selling volatility? Now, first of all, the structural issue that I mentioned to you is volatility high. So people want to kind of try to harvest that energy that is coming out. But how can you use it to your advantage? I do multiple different strategies that we can cover, and probably if you're interested in another time, for example, carry, for example, arbitrage between futures markets and different exchanges, all this different fancy stuff that is actually very quantitative. But there is something very simple, okay? Which is, if you want to set, I want to accumulate more coins, for example, I can actually sell put options with a particular set of strikes. If I tell you, for example, that you get compensated at the moment in time. We actually go $97,000, let's call it price now. And I said that you can actually sell put options at 85 or 82 for 2 weeks, and people is going to compensate you for that. Would you actually do that? And that will give you the ability to buy at that particular level. So the payoff would be at the end of the 2 weeks or 1 week, if your Bitcoin is trading to that particular level, you will actually receive BTC. Would you be keen to do that as opposed to paying the 97? What is the risk? Well, the risk is actually there is an 105 and never go to that level, but you actually receive premium for that at what we actually to be described to be a high volatility. So what actually a lot of institutional clients use this is as a way to enter and decide where I want to buy those assets and what I'm going to buy that Bitcoin. It's a particular level. So you have a bit of that discretion to do. 2, that premium that you're receiving, you can actually generate yield. You can express it as a yield of that particular investment. So going back to the point that I mentioned before about you want to make sure that those coins are working for you, well, here is a way that instead of actually leave the coins idle, you will say, oh, I'm going to actually generate some yield for that, and I want to express it in that way. That premium is reflected as a way to that. And lastly, a lot of the institutional treasurers and people that are holding BTC, they want to do something that diversifies them from lending the coins. And I know that probably a lot of you have experience of that. You maintain your treasury of BTC, but you need to kind of do something with that in some portion. So what is the initial thought that you have? OK, well, I'm going to take some credit risk. Let me actually lend those coins to someone. Well, we know that it's a market that is actually very one-way. It's either too many people with too many coins or some people with too many dollars, and that's actually very difficult to kind of measure, and there's the credit exposure that you have there. But here, if you actually have the ability to take advantage of that mature infrastructure, those volumes that I talked to you about, open interest in terms of a derivatives market that you have currently in the option market for Bitcoin, you could actually diversify that source by basically doing yield. Now, I'm going to move on quickly. So pretty much, this is something that we do systematically for people. And just kind of illustrate a bit. So someone wants to sell puts to a particular level. They basically sell the puts. The strike get exercised, let's assume, actually falls. OK, you get exercised. You receive a perpetual. You technically get a high exposure. There's a couple of things that you can do. You can actually sell calls to get rid of that excess exposure if you don't want to maintain more BTC, or just simply you keep the exposure, and then you can accumulate more of that. So now the question, and it's very interesting, is that you need to kind of put more capital. You put your capital, which is basically the original Bitcoin that you have in your strategy, and you put that to work. OK, so very, very, very important. Now, going back to what I said about the distribution, the symmetric distribution of returns of BTC, it is very important to understand that, yes, the coins, BTC, move on price. OK, today we actually have a 2% change. Well, 2% change, as I show it to you, is now the 5% best returns that you can actually have in BTC, because we said that the average or the mean is around 6.2%. But 2% is actually a tail event in the equity market, as we said for the S&P 500. It's on the 5 best percent, it's actually below, but the 5% best daily returns is actually significantly lower than the 2%. So again, what I'm saying to you here is that, yes, BTC can be more volatile, can be more risky, but in the sense of movement, not in the sense of capital destruction. So how can you take advantage of that is super important. So I want to show you some interesting numbers here. By taking a very small amount of risk here, you basically have the ability to accumulate more coins. So here is actually something that is a live performance that we have done. The returns go from 59 to 70% in the dollar terms. And the volatility actually go from 67% to 69%. So if you are actually holding BTC or Bitcoin, I mean, the volatility is 68% versus 69.5% is actually not going to make a difference in terms of what you see. But you actually can see how you improve all your risk and return profile, which is super key and important. But the bad news is that it's not straightforward. Okay, it's a multi-dimensional problem. When you're actually going to sell volatility, I mentioned to you, you want to know when the volatility is in the right market, what the market environment is actually appropriate, what sort of delta, so basically strikes, are you going to actually do that? For example, you're not going to sell volatility when the market is tanking and you are in a period of the downtrend. So there is ways that we assess it, for example, by looking at trend following signals to assess where we are in the market, making sure that we don't sell risk, that you size the risk. It means that basically volatility versus the delta. So there is a lot of different sort of tools that are actually available because we know that that infrastructure is now currently mature and you can take advantage of that. The only thing that you need is make sure that you educate yourself, you understand the risk, or you actually get the help of someone who can actively manage that risk for you. But it is a very interesting way to take advantage of that volatility that is structurally high. And that's the important, going back to the point about the reactor, you get all that energy. Let's make sure that we harvest that energy in a way that you can accumulate more coins and actually generate better returns. So I'm going to stop here, and great to have the opportunity to be with you here. Okay? Thank you.